Welcome to The Millionaires, which help you better understand personal finance, investing, and wealth management. We believe that financial literacy is crucial for everyone, regardless of their background or financial status. In this video, you will know about how to prepare and protect your investments. Thank you for your interest in learning about how to prepare and protect your investments in the event of a stock market crash. While the thought of a crash can be daunting, there are steps you can take to mitigate the risks and come out stronger on the other side. First, let's talk about what a stock market crash is and why it happens. A stock market crash occurs when there is a sudden and significant drop in the value of the stock market as a whole. This can happen for a variety of reasons, such as a global economic downturn, a major political event, or a crisis within a particular industry. When a crash occurs, investors may panic and sell their holdings in an effort to minimize their losses, which can lead to a further decline in stock prices. So, what can you do to protect your investments in the face of a crash? Here are some strategies to consider. Diversify your portfolio. Diversifying your portfolio is a key strategy for protecting your investments and reducing your risk exposure. Essentially, portfolio diversification means spreading your investments across different asset classes, sectors, and regions to avoid relying too heavily on any one company, industry, or market. The idea behind diversification is that different types of investments perform differently under different market conditions. For example, stocks may perform well during a strong economy, while bonds may perform better during a recession. By diversifying your portfolio, you can ensure that you have exposure to a variety of investments that may perform well under different market conditions. One of the simplest ways to diversify your portfolio is to invest in mutual funds or exchange-traded funds, ETFs. These funds typically hold a mix of stocks, bonds, and other securities, providing investors with exposure to a diverse range of investments. For example, an S&P 500 index fund will invest in the 500 largest publicly traded companies in the United States, providing investors with exposure to a broad range of sectors and industries. Another way to diversify your portfolio is to invest in different sectors or industries. For example, if you have a significant portion of your portfolio invested in technology stocks, you may want to consider investing in other sectors such as healthcare, consumer goods, or energy. By diversifying across different sectors, you can reduce your risk exposure to any one industry or company. In addition to diversifying across different asset classes and sectors, it's also important to diversify geographically. This means investing in companies and markets outside of your home country. By investing in international markets, you can gain exposure to different economies, political systems, and market conditions. Invest for the long term. Investing for the long term means making investments with the intention of holding them for an extended period, usually 5 years or more. It requires patience, discipline, and a long-term perspective. By investing for the long term, investors can benefit from the power of compound interest and market growth over time. One of the key advantages of investing for the long term is that it allows investors to ride out the ups and downs of the market. Short-term market fluctuations and volatility can be unsettling, but over the long term, market trends tend to even out, resulting in more stable returns. Another benefit of long-term investing is that it reduces the impact of transaction costs and taxes, which can eat into returns over time. By minimizing turnover and holding investments for the long term, investors can save on fees and taxes, and reinvest those savings into their portfolios. So, it's important to remember that investing is a long-term game. While there may be short-term fluctuations in the market, history has shown that over the long term, the market tends to go up. In fact, between 1926 and 2020, the S&P 500 has had positive annual returns in 74% of those years, despite experiencing a number of crashes and corrections along the way. If you have a well-diversified portfolio and can weather short-term downturns, you're more likely to see positive returns over the long term. Have a plan in place. It's important to have a plan in place for how you will react in the event of a crash. This may include setting stop-loss orders on your investments, which will automatically sell your holdings if they reach a certain price point. You may also want to have a predetermined plan for how you will rebalance your portfolio if certain investments decline in value. By having a plan in place, you can avoid making emotional decisions in the heat of the moment. Keep an eye on your investments. Keeping an eye on your investments is crucial to ensure that you are on track to meet your financial goals. It involves monitoring the performance of your investments, tracking market trends, and making adjustments when necessary. Regularly reviewing your portfolio can help you identify opportunities to rebalance your holdings and adjust your investment strategy to align with your changing needs. It can also help you spot potential risks or red flags that could impact your portfolio's performance. Monitoring your investments can also help you stay informed about the latest market trends and economic news that could impact your portfolio. This information can help you make informed decisions about buying, selling, or holding investments. Keeping an eye on your investments is a critical component of successful investing. By staying vigilant and informed, you can make better investment decisions, optimize your portfolio's performance, and achieve your financial goals. Consider alternative investments. In addition to traditional stocks and bonds, there are a variety of alternative investments that may offer greater protection in the event of a crash. For example, real estate investment trusts, REITs, are investments in companies that own and operate income-generating real estate properties. Because these investments are tied to physical assets, they may be less susceptible to market fluctuations. Similarly, commodities such as gold and silver may offer a hedge against inflation and market volatility. When someone is considering alternative investments, they are exploring opportunities outside of traditional stocks, bonds, and mutual funds. Alternative investments can include real estate, commodities, private equity, hedge funds, and cryptocurrency, among others. These investments can offer unique benefits such as diversification, potentially higher returns, and reduced correlation to traditional markets. However, they also come with increased risks, including illiquidity, limited regulation, and lack of transparency. Before investing in alternative assets, it is crucial to thoroughly research and understand the risks involved, as well as any potential tax implications. It is recommended that individuals consult with a financial advisor before making any investment decisions. Consider professional advice. Finally, if you're unsure about how to protect your investments in the event of a crash, consider seeking professional advice. A financial advisor can help you assess your risk tolerance and develop a diversified investment strategy that aligns with your goals. They can also provide guidance and support during market downturns. In conclusion, while the thought of a stock market crash can be scary, there are steps you can take to protect your investments and come out on top. By diversifying your portfolio, investing for the long term, having a plan in place, keeping an eye on your investments, considering alternative investments, and seeking professional advice, you can minimize your risk and maximize your returns. It's important to remember that investing always carries some level of risk, and there is no surefire way to completely avoid the impact of a market crash. However, by taking a proactive approach and implementing these strategies, you can better position yourself to weather any storm that comes your way. One final piece of advice: don't let fear dictate your investment decisions. While it's natural to feel nervous during a market downturn, it's important to remain calm and focused on your long-term goals. Keep in mind that the stock market has historically recovered from crashes and corrections, and there is no reason to believe it won't do so again in the future. So, if you're worried about a potential stock market crash, take a deep breath and consider implementing some of the strategies we've discussed. With the right approach, you can protect your investments and continue working towards your financial goals, even in the face of market volatility. Okay friends, I hope you like this video and you get good knowledge from it. Don't forget to subscribe to the channel for such a valuable video. Thank you for watching.